Welcome back to our second segment. And this segment is again for December 2nd, 2023. And we will discuss emerging markets and the lessons of the week. So with emerging markets, as you can see, this is as of Wednesday. There were quite a few red as of Wednesday, but as a whole, you can see there are many markets have done very well this year, and especially again with the weakness of the dollar, it has really helped a lot of international markets. So this week, what I'm going to look at is, again, it's a 2 months, and we talked about last week, seeing how nicely they have really reversed the course and they've stayed above their 20 and 50-day moving average. I included RSI indicator on top of just the moving averages, at least to give you some ideas of, are we in a more of an overbought markets or not? So you can see based on again, some of the movements, you can see India just went to the overbought. Looking at Germany, for instance, has been overbought for a long time. When you look at 3 weeks, so basically, you look at the Spain. So is there a chance there will be some reversals? Markets can be overbought for a long time, but once the reversal happens, then things will take a break. You see, really the weakest of all the markets is still China. It's a lot of mismanagement, in opinion, with what's going on there. So, but a lot of strength in a lot of markets, as you can see. As far as some of our lessons, I'm looking at emerging markets. You can see, I want to look at the sovereign bond funds and some of the best and the worst of this is from the Bloomberg emerging markets, based on using the USD index. You see that really the stellar performer was El Salvador, and it was up 105%. This is just year to date, and this is as of November 20th. And of course, they were supposed to default and they didn't. And then Pakistan is up 66%, Sri Lanka is up 62%. So those were the stellar, again, performers. And then when we look at the decliners, we see that Bolivia was a big loser, down 32.5%. They have declining reserves, and then Ecuador was down 18.5%. And again, there's always that political uncertainty with these Latin American countries. So there were a few countries, 9 countries, that they actually have, we have to think about that they are in defaults. And from Lebanon, Venezuela, Ukraine, Belarus, Ghana, Sri Lanka, Russia, Zambia, and Suriname. So just ideas as far as where these countries are. Continuing with that is I'm looking at basically countries that they have the yields of 10%, and these are the Euro bonds. And again, we are excluding the countries that they are at default, and looking at the yields. For instance, we see Ethiopia has a yield of 63.3%, Argentina is 39.8%, Ecuador we just spoke. So these are just looking at the yields of over 10%. Now Papua New Guinea is at right above the 10, and Iraq 10.3. Just food for thought there. You want to look at the whole. If you're looking at the yield, we want to look at the real rate and basically take a look at the fundamentals of the country. But this is the countries with a lot of higher yields. And continuing with that, we are looking at again Asian economies, and with the usually are above average of the global economy's GDP. And looking at the Philippines, it looks like they are going to be have a better growth in upcoming year in 2024, ahead of Thailand, Malaysia, Indonesia, and Vietnam comes a close second. So remember, in 2022, we had Vietnam and Malaysia, the stellar performers. But this was interesting. So that 6 lessons that we learned from the emerging market equities so far in 2023 is that the technology sector really came back. It's a global market leadership. Of course, we think about AI. War risk is not priced uniformly across regions. Crisis recovery trades beat structural reform and growth ones. When China and India move big, they move inversely. And you could see from the charts that we looked at, elections are hard to predict, but can outweigh all other factors. And passive strategies that mirror benchmark indices are flawed in emerging markets. Talking about that, this is end of November. Just want to look at some of the returns so far in 2023. Developed versus emerging markets, ex-China, Africa, ex-South Africa, frontier emerging. Again, these are more of a reference, but we can see like in large emerging markets, Mexico is up 28%, Brazil 23%, Taiwan, Korea. And then we look at China, Hong Kong, and Thailand down. In Asia, Sri Lanka and Pakistan are leading. And then we see in the Middle East, Dubai up, but Kuwait and Jordan down. Again, there's some geopolitical problems you have to take into consideration. And the emerging markets in Europe, you see Georgia up 52, Kazakhstan is up 50. On the other hand, Iceland, Ukraine, they're the laggards, Argentina, Peru, and then we look at Jamaica, and we're looking at Kenya in Africa, for instance, compared to Nigeria. So just a reference. So let's go to lessons of the week. This was, again, November was magnificent. Look at this. I mean, S&P was up 9%, and NASDAQ was almost 11%. Year to date, we are close to 21%. Dow is about 11%. And NASDAQ is 47. So I will leave this with you. Just take a look at it. Now, when you look at the equal weight, finally, the S&P, we had discussed this, I guess, again, a month ago. They're up only 6% year to date compared to 20. And that came all from November. So the question I have is, we want to look at for the past 2 years, when you included 2022 in this configuration, and look at this. S&P is only up 3% in 2 years. NASDAQ is completely flat, and equal weight is flat. So basically, when we look at the 2-year, you see energy is the big winner, up 68%, although it's down this year. And technology is up 11%, and communication services are down 5%. Brazil is up 45%, and we look at Mexico, these are for the 2 years. So just again, you want to look at, are you a long-term investor? What has happened? You know, this was a really good year, and what's going to happen next year? But again, I thought this was interesting to take a look at things in perspective. So I talked about interest rates. I mean, amazing how things can change so rapidly in a month. Now, this is our Fed watch, and I went to March. So first, last week, we talked about second quarter in June. We look at March. So what it tells us that, you know, we are at 5.25 to 5.50, and market has said that, you know, Fed is going to do nothing this coming meeting. So there's over 70% chance that the rates will be cut by March. 70%. Now you can see why the interest rates are keep going down and why the dollar is getting affected. just look at when we look at, again, this is 70.8%. A week ago, on November 24th, there was only 21% chance that the rates will go down. And 1 month ago in November, there was about 25.5%. So anyway, I thought, it's important. Even a day ago was 63. So Powell speaks, and here we are. So you can see being unchanged was 70% a week ago. Now it's 28%. So I hope that helps you to understand. Now, we are in December, everybody is excited. We got the Christmas coming. So we've had the Santa Claus rally, which has happened, and we look at the 126 years history in the Dow, and you'll see that generally it starts on December 15th, and it goes till like January 9th. Some people say it starts the 25th of right around Christmas, and it goes first week of January, but this is a general idea. The December 15th is more accepted. And I will show you a chart actually of the Dow, and we also talk about DAX. So when we look at this, is more, in the Santa Claus rally, again, on annualized basis, the return is 40.4% on only 17 trading days. For comparison, the average, Dow Jones during the rest of the time is only 3.17%. So it's interesting, just a food for thought. When we look at the pattern, again, this is from 1898, prices rose almost 78% of all that means out of 126 years, only 28 years, the prices did not go up. And basically, again, we have charts for the Dow and DAX that I will share with you. And you can see, again, from December 15th to January 9th. Let me show you that, and then I'll go back to the, so you see, this is what happens, and this is for the 126 years, and the pattern, and this is the DAX. It goes down and it goes up. That's for 43 years, and every year that we've had in the past 43 years. So we look at all the returns. So what drives the Santa Claus rally? So there's a lot of explanations. Of course, we talked about the seasonality. Now, we've talked about end of the quarter, end of the year window dressing. So that's one of them. So basically, of course, they look at the winners, they get rid of the losers. Actually, it starts end of October. A lot of funds do that. So the other side is when you have a good year, you actually want to show even better return because you get bonuses based on performance. So they want to get bonus payments. So that's another reason, again, for the window dressing. I think the main reason is after Thanksgiving, the mood, right? It's the psychology. People are in a move of giving. They feel positive. They have their first of the year, again, their whole wish list, what they're gonna do, and so again, it is a holiday effect. It is a good feel effect. So that's one of the, again, probably main reasons. And on top of that, with that idea, we talk about Black Friday, we talk about Cyber Monday, people start shopping, which obviously it's good for the retail and other related sectors, and most of actually retailers made all their money this month than 11 months, the rest of the 11 months. So those are some of the reasons for this rallies. A few other tidbits, and I'm going to relate this to the next slide. So let's work on this. Wealth for the median household, the midpoint between like the richest and the poorest household, jumped 37% between 2020 and through 2022. This is from the Federal Reserve, and it is $193,000. That's just for inflation. And it's mainly, though, it's because of the home values and higher stock prices. and a lot of more people nowadays own stocks and homes. And on the other hand, about 47,000 students, completely different story as far as choosing your major. 47,000 students earned bachelor's degree in accounting in 2021 to 2022. That is down 7.8% from prior year. And what happens is about 18,240 of these students received master's degree in the academic year, which is again down 6.4% from the prior. And it is a net drop 2.8% and 4.7% for the graduates with a bachelor's and master's degree compared to the prior year period. So overall, the number of US accounting graduates with either degrees dropped 7.4%, and which is the largest drop in a single year since the 1994 to 1995. Another story is about NBA's jersey patch sponsor. This is the patch sponsor program kicked up during the 2017-2018 season. That's when they started. And it's been an important revenue for actually clubs. The NBA's top 3 jerseys sponsorship generated roughly 100 million last season. So these are just some different figures I thought to share with you. I just talked about this, the median income. Now, as you know, we have election coming up next year, and you look at the employment, which is fantastic. So people are doing well. You look at the holiday, you look at actually retail sales, and you look at the markets, and you would think that President Biden, this should be a runaway. I mean, there shouldn't be any Of course, one of the biggest concerns have been, you know, I don't think he's getting credit for whatever, has happened in the economy. And, it's the question mark, right? So either, generally when things go bad, the presidents get blamed. And when things go well, although it might not be even part of their action, well, they get the credit. So there's this puzzle. And I think one of the reasons I look at this puzzle is, when you look at average person, you look at their as far as effects of everyday spending, I think this might help to understand the people, that good feel is not 100% there. And I thought these numbers were interesting. This is from January of 2021 when President Biden got elected and took the presidency. And the household rents are up 18%, grocery items are 20%, airfares are 21%, used cars 23%, utilities are 24%, vehicle maintenance is 27%, and gasoline, even though everything is down, still up 45%. So it affects everyday person's pocketbook. And although they're working and making more money, but net, they feel like they're losing. So I don't know. I mean, I'm not politician. Don't want to even get involved with politics, but I thought this might help to understand why there's not all the credit taken. So as far as the another lesson, the VIX, you can see the VIX is not really has been a great indicator of, talk about fear gauge with all the, again, very short-term options, 1 day to expiration. But this caught my eye, and I looked at the 30-day. So I'm looking at the January 3rd, which is 30 days from now, and that's what the volatility wanted to see for the next 30 days, what will happen. These are the options on the VIX itself. So, and you can see this, look at this implied volatility. It's completely expanding, and it's like more and more expensive to get out of the money calls. So there is activities in buying VIX for safety, whether that's skew or when we look at, for instance, calls activity, you see the sizzle index is more on the call and puts. Even when you look at the puts, look at this, there are a lot of them are sold at the bid. So, and there's a lot at the ask and the call. I mean, it's a little more than what is at the bid, but this is a big discrepancy. So I want to just, again, we looked at the charts, things are looking good, but there is still a little concern just based on, again, purchase of these VIX options. Anyway, I hope that was helpful. This is the end of our session, end of the last period for our lesson of the week. And we'll go to our third segment, which is the trade of the week.